In the part 3 of Banks Lending Rate System series, we will be discussing the base rate system in detail. Along with that, we will also see why base rate system was slow and incomplete in policy transmission and why there was a need for a new lending rate system for emerging economy like India. Along with that, we will also see what is repo rate and what is the importance of repo rate in banks' lending rate system. RBI replaced the benchmark prime lending rate system with the base rate system in July 2010, under which the actual lending rate charged to borrower were the base rate plus borrower specific charges. Let us find out the main components of base rate system. So base rate system comprised of number 1, the cost of funds. Number 2, operating expenses to run the bank. Number 3, minimum rate of return. And number 4 is the cost of maintaining cash reserve ratio. Why it is cost? The cost is because every bank has to keep certain amount of their demand and time liability with the central bank in form of cash reserve ratio. So keeping that much amount of money with the central bank means banks have to do business with lesser resources. That is the business of credit creation. So the more the CRR, the lesser will be the credit creation of the bank. Therefore, higher CRR is taken as a cost for the banks. Now let us find out what were the advantages of base rate system over the earlier lending rate systems. So base rate system was expected to facilitate better pricing of a loan, enhance transparency in lending rate, and improve the transmission of monetary policy. Along with that base rate system, each bank was required to announce its base rate, taking into account all cost of borrowing fund. Base rate was to be the minimum rate for all loans, and it should ensure that bank cannot lend below certain benchmark rate. The very important advantage of base rate system was the base rate system aimed to ensure that the changes in the interest rate should effectively transmitted to the bank customers. Let us find out the problems with the base rate system. The first charge against base rate system was issue of discrimination in pricing of credit between the new and the old borrowers. Borrowers who shifted from the benchmark prime lending rate to base rate system were charged a spread higher than the borrower who entered the base rate system directly, leading to the issue of discrimination between the old and the new borrower. As banks often adjust the spread over the base rate to benefit their new borrowers. Another charge against base rate system was it had various methods in calculating the cost of fund. Base rate system ensures that the change in the interest rate policy must effectively transmitted to the borrowers, but the policy transmission could not become very effective in the base rate system because banks adopted various methods in calculating the cost of fund. The average cost method, the marginal cost method, the blended cost method, which is having both average and the marginal cost. So in practice, the base rate system, banks were given too much flexibility to adopt various methods in calculating the cost of fund, which resulted in lack of uniformity and transparency in the determination of lending rates by different banks and rendered the assessment of monetary transmission difficult. Next charge against base rate system was it was not very effective method in policy transmission. Base rate primarily depend on the composition of current account and saving account and deposits to calculate lending rate. Most of the banks were following average cost of fund for the calculation of base rate. Banks do not consider repo rate in their calculation. So any cut or increase in the repo rate by RBI was not getting transmitted to the bank's borrower immediately in base rate system. What is repo rate and what is the importance of repo rate in bank's lending rate system? We know that RBI lends money to commercial banks and commercial bank lends money to the public. Repo rate is the rate at which RBI lends money to commercial banks. It is the rate under liquidity adjustment facility for effective management of liquidity in short period of time. So any change in repo rate, increase or decrease in repo by RBI must reflect in the change in the interest rate done at commercial banks level, so that any decision taken by RBI in terms of the change in repo must give benefit to the borrowers of the bank. So suppose RBI wants to increase liquidity in the market in a short period of time, it cuts the repo rate. So borrowing of the commercial bank will become cheaper. This benefit must be shifted to the borrower by cut in the interest rate. So if RBI cuts repo by 125 basis point, so in the base rate system, it was also expected to cut the interest rate in same proportion, but what was found that the marginal effect of rate cut was not completely shifted to the borrower. So in that way, the base rate system turned out to be very slow and incomplete to the change in the interest rate with the change in the repo rate policy of RBI. Therefore, there was a need to bring more transparency in the interest rate or a bank's lending rate, and need to link the lending rate directly to the market determined benchmark in order to pass the benefit of rate cut at RBI level to the borrower and ensure that availability of loan to the customer or a borrower should be done at a fair price. Base rate system therefore suffered with the problem of slow and incomplete policy transmission. Ideally, any change in the repo rate must reflect the change in the lending rates of banks. If RBI takes any decision to either increase or decrease the repo rate, it must be reflected in the change in the lending rates of the bank so that the benefit must go to the borrower. But the policy transmission under base rate system was not very effective. The former governor of RBI, Dr. Raghuram Rajan, in his monetary policy in January 2015 said that since the rate reduction cycle that commenced in January 2015, less than half of the cumulative policy repo rate reduction of 125 basis point, the median base lending rate has declined only by 60 basis points. This means that Dr. Rajan-led RBI has cut the repo rate by 125 basis points, but banks in turn have cut their lending rate by only around 60 basis points on an average. This clearly tells us that the monetary policy of RBI in process of setting interest rate has only been half effective in base rate system. So the slow and incomplete transmission in the base rate system led to the need for a new lending rate system. Why there was a need for a new rate? Because an economy like India, cut in a lending rate made by the central bank must reach to the common man at the earliest, as these cut in the lending rates would support public to take loan and invest in various investment opportunities. If the public will get loan at a reasonable rate, they will use that loan for the investment. They will buy home, they will start a business, and they will have new investment opportunities. So if there will be more of investment in the economy, it will be definitely going to increase the income, output and employment. Because the more will be the investment, the more will be the multiplier times increase in income in the economy through investment multiplier. And as a result, this will help in the growth process of Indian economy. This is possible only when banks will implement or update cut rates as quickly as possible in a uniform and a responsible manner. If you have any question on this presentation, please put your question in the comment section and like and subscribe my channel to get further notification. Thank you so much.